If you have a trust and you have an A, B, or C, then you may want to take a look at it again. Let's say you just did it 10 years ago and the estate and gift tax credit was $650,000. You've got $1.5 million, let's say, estate today. And if you got an A, B setup, you know, can you handle that complexity? Can the surviving spouse handle that complexity? Because if the trust says you have to divide it into the A, B, what if the trustee says, oh, there's not enough assets here, and gosh, we don't need to go through all this rigmarole. Do they have to do it anyway?
California says that this was a contractual agreement between the two of you when you created the trust. And so when one person dies, the survivor doesn't have any choice. The survivor has to do whatever split is set up in the trust. Now, the fact of the matter is probably 75% of the times they don't. They never even think about it again because they think, I had a living trust. That means I don't have to go to probate, so I don't do anything at all, which not going to probate's over here, not doing anything at all is over here. We just kept you out of probate. We still have to make this split. We still have to make this work. Because if we want to say these assets are protected from creditors, just like earlier Pete mentioned, we've got to respect the formalities of the trust. We have to respect the formalities of the trust. The only reason this is protected from creditors is because these were my assets. I put them in here, and nobody's used them inappropriately. So we've got to do it. And one of the questions that we wanted to talk about is, if you did your trust anytime in the last, well, probably since the late 80s, it's probably got an ABC split, if you were married when you did it. Some trusts aren't going to have the C because the choice will have been, I had more than I could protect with my credit. I had $5 million plus I had an extra $5 million. And instead of creating an extra trust, it has to have a taxpayer ID number and a return every year. I'm just going to put this extra over into the survivor's trust. Okay, so that gives you an AB trust instead of an ABC trust. But chances are this is how your trust is structured, because this has been the way of doing trust since 1986, when the marital deduction became what it is today. So the real question is, do you need this? Because one of the alternatives...
We have less than 10 minutes.
Okay. So let's say that we do this thing again. We have the Powell Family Trust. We have $10 million over here. Well, we have to use $10 million because we're talking about a $5 million credit. So even though that number seems crazy, let's just go with that. So we have $10 million over here and $10 million over here. I die. We do my credit. Do the survivor's trust. Okay, so here's our A, here's our B. The survivor's trust is just like the Powell Family Trust in regard to the survivor. There's no taxpayer ID number, there's no tax returns, there's no difference. The half that's over here is going to get reported under her Social Security number, paid on her taxes, and it's going to be really easy. This thing over here, though, this is I run with spikes. This is an irrevocable trust. Oops. An irrevocable trust. The spikes are what keep the creditors out and the divorce courts out and the companion boys out and everybody out. But to get this, I have to have a separate taxpayer ID number, an employer ID number, taxpayer ID number. I have to file a tax return every year. I have to keep track of what income came in, what income went out, so that I know who's supposed to pay the income tax on that. I have to do all those things. That's part of the formality of the trust.
Does an irrevocable trust have the same income tax rate as a regular person?
No. Irrevocable trusts hit the top tax bracket. Is it 35% now federal? At about $11,000 of income. You have to get almost $400,000 if you're an individual to hit that top tax bracket. So if we've got income coming into one of these trusts, these irrevocable trusts, I don't want to leave it in there because we're going to hit the top tax bracket right away. I'm going to want to take that income and pay it over here so that pay it to the survivor, to the spouse, so that spouse has got that chance of running up those rates and not hitting that top tax bracket.
So when we do something like this, we have to be concerned with income tax rules. We also have to be concerned with what assets go into which trust, because they're going to have to be retitled. And that's a tax question as well. Okay, who's going to be the trustee and keep track?
The assets that go in here, the other thing that's strange to think about is, you know how when you sell your house, you can protect $500,000, $250,000 a piece in gain? Not if it's in here.
Houses irrevocable trusts do not get Prop 13 protection.
Right.
No Prop 13?
No, not in the below ground trust.
No Proposition 13 and 58, or just the exemption 250? No, so it can go up higher than 2% everywhere?
Zero.
Oh, it doesn't change?
No, it doesn't get any protection whatsoever.
What the franchise tax board will look at, and the county will look at, is you can make the argument that this is the same if the income goes to the spouse, all that kind of stuff. But technically, since you could leave this income to 50 different people, that's where the county will say, nope, you got to prove to us that we should give you this because it's going to the spouse. So it's not automatic, and it's a bit of a fight sometimes, especially when the counties are broke, like they are right now. And they're trying to bill for everything they can.
And what they look for is someone who doesn't follow the formalities. Right. Okay, that's what they look for. Most of the audits on the 706 return is not checking the correct box. It comes down to that simplicity. What is the average revenue of an estate and gift tax agent?
The estate and gift tax people look at an estate if they can generate more than $5,000 per hour of additional tax. And now that they've got this weird, they're looking at every return because they've got nothing else to do, and they're living inside this goal of $5,000 of difference, they're starting to make some crazy claims and they're pushing on things we've never seen them push on.
So, is there a person, if no matter what size the estate you have, you should not be paying estate and gift tax if you do it right? Mark, in his little bag of tricks, has life insurance trusts. He has family limited partnerships. You have special needs trust. There's just a slew of different documents. If giving the proper time and energy, there is not one individual that ought to be paying estate and gift tax. But the larger your estate, the more formalities have to be followed. And so you have to spend some dollars in order to escape those estate and gift taxes. And one of the things that Mark was mentioning is that we're kind of strange here in Orange County because we have a very high net worth just in real estate alone. This is not the way it is in the rest of the country. Okay? And so we need to kind of take a look at our own estate and see whether or not we're going to be subject to that tax. Two, can we understand the formalities involved? And three is that do we want to leave the children in it outright or in trust?
Right.